Investing isn't just for the wealthy or for people who work on Wall Street. In fact, it's something that anyone can do, no matter your background or how much money you have to start with. The idea that investing is only for the rich is a myth. Today, it's more accessible than ever before. Whether you're a student, a young professional, a parent planning for your children's future, or someone thinking about retirement, investing is for anyone who wants a secure financial future. It's about making your money work for you, so you can reach your goals, big or small. At the heart of investing for most people is something called a fund. But what exactly is a fund? Simply put, a fund is a pool of money collected from many individuals, all brought together and managed by a professional. This manager invests the combined money in a variety of assets, like stocks, bonds, or even real estate, on behalf of everyone who contributed. Imagine you and your neighbors want to throw a big block party. Instead of each person buying their own food and decorations, everyone chips in a little bit of money. With that pooled amount, you can afford something much bigger and better than you could alone. That's exactly how a fund works. By combining resources, you unlock opportunities that would be out of reach individually. By pooling your money with others, you gain access to a diversified portfolio. This means your investment is spread across many different assets, reducing the risk that comes from putting all your eggs in one basket. You don't need a fortune or deep financial expertise to benefit from this approach. Diversification is a key principle in investing. It's like not putting all your eggs in one basket. If one investment doesn't perform well, others in the fund can help balance things out. This helps protect your money from the ups and downs of the market. Funds make investing not only safer, but also much more accessible for everyday people. You don't have to be an expert or spend hours researching individual stocks or bonds. Instead, a professional manager or even an automated system, sometimes called a robo-advisor, handles all the research, buying, and selling for you. This means you can invest with confidence, knowing your money is being managed by experts. This approach allows you to participate in the growth of the market, sharing in the profits and potential, but with less risk and effort than if you tried to do it all on your own. Over time, even small investments can grow significantly. Funds can invest in a wide range of things: stocks, bonds, real estate, and more. This opens the door to long-term wealth building, giving you a chance to benefit from different parts of the economy. You don't need millions of dollars or a finance degree to get started. With just a small amount and a bit of curiosity, you can begin your investment journey today. A fund is one of the most powerful tools for building wealth over time. And the best part is, it's available to everyone, no matter where you're starting from. Don't let the complexity or jargon keep you from investing in your future. With funds, you have a simple, effective way to grow your money and achieve your dreams. ETFs, or exchange-traded funds, combine the diversification of a fund with the flexibility of a stock. You can buy or sell ETFs anytime the market is open, with prices changing in real time. Most ETFs are passively managed, tracking indexes like the S&P 500, which keeps fees extremely low. Low fees mean more of your money stays invested and grows over time. ETFs are great for both beginners and experienced investors who want flexibility and low costs. You can invest in broad markets or specific sectors with a single purchase. If you want a simple, transparent, and flexible way to build wealth, ETFs are a fantastic choice. They're modern, efficient, and accessible to almost everyone. Index funds are the ultimate set-it-and-forget-it investment. They simply mirror a market index like the S&P 500 by owning all its components. No fancy managers, no trying to outsmart the market, just steady, low-cost investing. Because they're passively managed, fees are rock bottom. Over time, very few professionals beat the market, so index funds let you capture the market's strong long-term returns. Unlike ETFs, index funds only trade once per day at the closing price, which helps you avoid impulsive decisions. They're perfect for long-term investors, especially in retirement accounts. You get broad diversification, low costs, and a proven track record. Don't overcomplicate it. Index funds are a cornerstone of smart investing. Simple, reliable, and effective. Mutual funds are the older cousin of index funds, pooling money to buy a mix of assets. Most are actively managed, with professionals trying to beat the market. This active management comes with higher fees, often much higher than index funds. Over time, most mutual funds fail to outperform their benchmarks, especially after fees. Some investors choose them for niche strategies, but for most people, the high costs aren't worth it. Like index funds, they only trade once per day. For most, low-cost index funds are the smarter choice. Hedge funds are exclusive, high-risk investment pools for the ultra-wealthy. They use aggressive strategies, like leverage and short selling, that aren't allowed in regular funds. The fees are sky-high, typically 2% of assets plus 20% of profits. Hedge funds aim for big returns, but the risks and costs are enormous. They're only for accredited investors who can afford to lose significant money. For nearly everyone, hedge funds are off-limits and unnecessary. Don't be tempted by the hype. Your path to wealth is through disciplined, low-cost investing. Hedge funds are a gamble, not a plan. Let's break down how these different types of investment funds stack up against each other, so you can make the smartest choice for your financial future. Each fund type has its own strengths, weaknesses, and ideal investor profile. Index funds and most ETFs are passively managed, which means they aim to mirror the performance of a specific market index, like the S&P 500, rather than trying to outperform it. This approach keeps costs extremely low, since there's less trading and fewer management decisions involved. Over time, these savings on fees can make a huge difference in your returns. On the other hand, mutual funds and hedge funds are actively managed. Here, professional managers try to beat the market by picking stocks or timing trades. While this sounds appealing, it comes with much higher fees and often inconsistent results. Many studies show that most active managers fail to outperform the market over the long run, especially after accounting for those higher costs. ETFs have another advantage. They trade throughout the day, just like stocks. This gives investors flexibility to buy or sell at current market prices. In contrast, index and mutual funds only trade once per day, after the market closes, which can limit your ability to react quickly to market changes. Hedge funds are the most exclusive and expensive option. They often require very high minimum investments and are only open to accredited or wealthy investors. Liquidity is limited, meaning you can't always access your money when you want. These funds also use complex strategies and take on higher risks, hoping for bigger rewards. For most people, ETFs and index funds are the best choice. They offer broad diversification, low fees, and simplicity, making it easy to build wealth steadily over time without constant monitoring or stress. Mutual funds might appeal to those seeking specialized strategies or access to certain markets, but it's crucial to pay close attention to the fees and performance history. High costs can eat into your returns, so always compare before you invest. Hedge funds are really designed for the ultra-wealthy, who are comfortable with big risks and complex strategies. For most investors, the high costs and limited access simply aren't worth it. The bottom line is clear. Low-cost passive funds like index funds and ETFs are the smartest path for nearly everyone. They keep more of your money working for you year after year. Focus on what you can control: cost, diversification, and discipline. These are the keys to long-term investment success, no matter what the markets do in the short term. Don't get distracted by complicated products or promises of high returns with high fees. Simplicity and low costs win in the long run. Remember, choosing the right fund can make all the difference in reaching your financial goals and building lasting wealth. Fees are the silent killer of investment returns. They quietly eat away at your wealth, often without you even noticing. Many investors focus on picking the right stocks or timing the market, but overlook the impact of costs. Yet, over time, fees can have a far greater effect on your final outcome than almost any other factor. Even a 1% difference in fees can cost you hundreds of thousands over decades. That small percentage might seem harmless at first, but it compounds year after year, quietly draining your potential gains. The longer you invest, the more damaging high fees become. For example, $100,000 growing at 7% for 30 years becomes $750,000 in a low-cost fund, but only $575,000 in a high-fee fund. That's a staggering difference, all because of fees. Imagine what you could do with that extra $175,000, whether it's traveling the world, buying a home, or enjoying a comfortable retirement. That's $175,000 lost to fees, money that could fund your dreams. Every dollar you pay in fees is a dollar you'll never see again. and a dollar that won't be working for you in the market. Every dollar paid in fees is a dollar not compounding for you. Over time, this lost compounding can make the difference between reaching your financial goals and falling short. It's not just about the money you pay today. It's about the growth you miss out on for years to come. Most managers can't beat the market after fees, so why pay more for less? The odds are stacked against high-fee funds, and history shows that very few consistently outperform low-cost alternatives. Don't let marketing hype convince you otherwise. Always check the expense ratio and keep it as low as possible. This simple habit can save you a fortune over your investing lifetime. Make it a rule to compare costs before you invest in any fund or product. Don't be swayed by promises of outperformance. Focus on what you can control. Markets are unpredictable, but costs are not. You have the power to minimize fees, and that's a decision that always pays off in the long run. Low fees are the surest way to long-term success. By keeping costs down, you give your investments the best chance to grow and compound over time, turning small savings into significant wealth. Be relentless about costs. Your future self will thank you. The choices you make today about fees can shape your financial freedom tomorrow, so make every dollar count. So what's right for you? Start by knowing your goals and how much time you want to spend managing your money. For most people, especially new investors or those saving for retirement, index funds and ETFs are the best fit. They offer instant diversification and low costs. Choose index funds if you prefer a hands-off approach. Choose ETFs if you want flexibility. A mix of both works well for many. Only consider actively managed mutual funds if you have a compelling reason and understand the risks and fees. Hedge funds? Just say no, they're not for the average investor. Building wealth is a marathon, not a lottery ticket. Stick to proven, low-cost, diversified strategies for long-term success. Investing isn't a secret club anymore. Low-cost index funds and ETFs have opened the doors for everyone. Your smartest path is simple. Own a diversified slice of the market through low-cost funds. Don't chase hot stocks or high-priced managers. Open an account, set up automatic contributions, and let compounding work for you. Ignore market noise and stick to your plan. The power to secure your future is in your hands. No finance degree required. Choose low-cost, diversified funds and stay the course. If you do, you're investing in yourself and your future. Security, dignity, and freedom are within reach. Make the decision, take action, and claim the future you deserve. Your journey to wealth starts now.